Hello traders, welcome back to Forex Mechanics. This video is specially for beginners. If you are about to start trading Forex, then this video is just for you. And what I have done is that, I have not tried to make it like just not too much information. This is all the information that you need to know if you are just going to start Forex trading, right? So what we're going to quickly discuss is what is Forex, what are the different market sessions, currency. We'll talk about currency pairs. We'll talk about pips, lot sizing, a little bit about risk management and leverage. So, if you're a beginner and you are just going to start off your Forex journey, then these are things that you need to know, right? Even before you start to trade, these are things that you absolutely need to know. And obviously, the most important thing is leverage. And I have purposely kept this topic right at the end, leverage, because that is the most important thing that you need to know and understand. And I've tried to keep it really simple because I don't want to, overcomplicate things, right? So let's just quickly go on with the first slide. So here we're talking about the Forex market. Now, if you've just started Forex, I'm sure you've Googled a lot of information, you have gone online, you've done your research, you must have gone to various different websites and you have already started your journey. But anyway, this is the first slide, and in the very first slide, I'm going to give you an information which you should remember till the time you're going to be trading Forex. So if you're trading Forex, there is something that I want to share with you which you have to remember, especially if you are a beginner trader. Unfortunately, a lot of people don't talk about it. So this is the very first slide. Of course, Forex means the foreign exchange market. It is definitely one of the biggest market. A lot of people, a lot of traders love this market because of the liquidity that the market has, right? If you've traveled abroad, you must have seen, when you exchange foreign currencies. So basically, when you say Forex, it simply means foreign exchange. You're just exchanging one currency with another currency, and that's how you make money. So any changes in the exchange rate between two currencies allows you to make money. Now, best part is that it's a 24 by 5 market, so it's open 24 hours, and you can trade any time of the day. Right? We will get a little more into the sessions in the next slide. But the most important thing that I want to tell you, if you are a beginner and you are just about to start, the very first slide has the most important information that you need to remember each time you are going to place a trade, right? If you can predict rising currency against a falling one, then you can make money, right? So if you're a beginner, this is the most important thing that you need to remember right now. If you can predict rising currency against a falling one, then you can make money, right? This is the most important thing that you need to remember, correct? Moving on. So let's talk about the market sessions. So when you talk about foreign exchange market, like I told you, that's open 24 hours. It's open 5 days a week. Now, of course, there are various sessions, but the major sessions where majority of the action happens is the UK session and the US session. Now, the maximum trading happens in these two sessions. So this is a very important thing that you need to remember, especially if you are a beginner. Remember that there are multiple sessions in the 24 hours, but these are the two most important sessions that you need to look at if you are trading. Now, if you want to really understand the various sessions in your country, then you can take this link. I'll tell you. So this is the link which is on your screen. I'll show you how it works. So when you go to this website, you can simply select the time zone that you are in. And once you select the time zone, it will automatically, calculate the various sessions, and it will also tell you the local time. As per your local time, it will show you the various session opens, right? So if you look at here, there is Frankfurt, then there is London, then there is New York, Sydney, and Tokyo. Now, for me, according to my local time, so you can see it's very clearly telling me that it's, for me, it is 11:30 in the morning. So 11:30 a.m. is when the Frankfurt Open happens as per my local time here. So you can select the time zone that you have, and it'll automatically tell you, what are the times that you should be really focusing at. So if you are a Forex trader, then these are the two sessions that you're obviously looking at the most. So for me, 12:30 in the afternoon till is when the UK market opens. So 12:30 in the afternoon, my local time here, is when the UK market opens. And then for me, 5:30 in the evening is again when the New York session opens. So you can see most of the action is happening in these two sessions. So you can see as of now, the UK session is open. The US session is yet to open, because the local time for me is 3:45 p.m. So in approximately in another 1 hour 45 minutes, another 1.5 hour is when the New York session will open, right? So that's about the sessions. This is the most important thing you need to remember: UK and the US session. Moving on, let's talk a little bit about the currency pairs. Right now, when you talk about the foreign exchange market, of course, there are a lot of currencies, there are a lot of currency pairs that you can trade in. But obviously, the most important currencies that we are really talking about are the 8 major currencies, which is the Australian dollar, the New Zealand dollar, Canadian dollar, pound dollar, the British pound, the euro, the Swiss franc, the US dollar, and the yen. So these are the 8 major currencies that we are definitely looking at. And of course, even when you look at, there are other currencies apart from this, but the maximum liquidity, the maximum volume is obviously happening in these 8 currencies, right? So when you pair them up, you get around 28 currency pairs, right? So anytime when you're looking at the forex market, so typically traders are looking at these 8 currencies, right? So you have it on your screen here, so you can look at that. Now, when you look at the currency pair, this is how the pair looks like. So here you have the euro dollar. Now let's say you see an exchange rate, euro dollar exchange rate is let's say it is 1.1955. Now this simply means that in order to buy 1 euro, it's going to take you 1.1955 US dollars. This is all you need to know. So if you see an exchange rate, euro dollar exchange rate is 1.1955, it simply means that to buy 1 euro, it is going to take you 1.1955 US dollar. So if I have to give you another example, let's say if the US Canadian dollar exchange rate is 1.2511, this simply means that to buy $1, you need 1.211 Canadian dollars, right? So this is what the exchange rate means. It simply tells you that how much of US dollars do I need to buy 1 euro, right? So whenever you look at an exchange rate, you simply understand that this is what it really means. This is the whole structure of the currency pair, and this is all that you need to remember and know, right? So when you look at the euro dollar, the currency on the left here is the one here is called the base currency, and the one on the left is called the quote currency, right? So the one on the left is base, the one on the right is quote. So base and quote, right? So the exchange rate, like I told you here, you can see euro dollar is 1.1955, simply means to buy one of the base currency. In this case, it is a euro. It's going to take me 1.1955 US dollars, right? So this is a typical currency pair structure, right? And like I told you, this is a beginner video, so I don't want to really confuse you too much. This is all that you need to know, right? So let's go to the other slide. Now, what is a pip? So basically any movement that happens in the forex market. Now, for example, you can see here that this is the euro dollar. The exchange rate is 1.1955. Now, let's say if I change this and I make this 5.6, so this simply means that this is a 1 pip move, right? So here in the forex market, you can call this a point or a pip, right? So every time there is a change in price or a small change in price, we call it a pip, right? So in this case, if you look at an example, so let's say the dollar rate is the euro dollar rate is 1.1205, right? And you can see here in the 4th decimal. So if price moves up to 0.6, price has moved up by 1 pip, right? So this is the 4th decimal. Now, if it goes up by 10 pips, so you can see it has become 1.1215. So from 1.1205, it has gone up to 1.1215. So that's a 10 pip move. Then you have another, let's say it has moved up by 100 pips. So what has happened here is 1.1, instead of 205, it has gone to 305. So this is a 100 pip move, right? So you can see a small change. So here's the 4th decimal, right? When it changed from 5 to 6, that's a 1 pip move. 1.5, that's a 10 pip move. From 205 it went to 305, that's a 100 pip move, right? And so similarly, if you look at it here, so here you have 1.2390. Now this is a US dollar, Canadian dollar, right? Now in this case, we are talking about, so in this case, we were buying the currency pair. So obviously, from 205 to 206, it's moved up by 1 pip. Here we are saying from 1.2390, it's gone down to 2389. It's gone down by 1 pip, right? So similarly, from 90, it's gone to 70. This is a 20 pip move. From 390, it's gone to 190. It's a 200 pip move, right? So it's very simple. This is all you need to know, that what does a 1 pip move mean, right? So you just need to understand 1 pip. So in this case, there's a fourth decimal. That's all you need to remember. So here it's moved up by 10 pips. So you can see 0.5 has gone to 1.5. When it went up by 100 pips, from 205 it went to 305, and vice versa when you are selling the currency pair or when the price is moving down. Correct? So let's move on to the next slide now. So in this case, one more thing I want to tell you is, let's take a look at the yen pairs now. So what happens in a yen pair is a little different. So here you can see, it is your entire currency pair, right? So here you can see it's right until the fourth decimal, right? It's until the fourth decimal here. It's 1.1205. But when you look at yen pairs, right, yen pairs are up to 2 decimals. So let's say if you're looking at a yen pair, and let's say the dollar yen rate is 120.10, right, 120.10, right? Here the second decimal is a pip. So here you can see 120.10 has become 120.11, right? This basically means it's a 1 pip move up. Similarly, if 10, so 120.10 has gone up to 120.60, this has moved up by 50 pips. Similarly, 120.10 has gone to 121.10, it simply means that price has moved up by 100 pips. Again, vice versa is true. In this case, let's say we've taken a pound yen rate is 150.20. So you can see each time a decimal drops, it's a drop by 1 pip. So here you can see it's dropped by 20 pips. That's why the price from 150.20 is 150. If it's a 100 pip drop, then from 150.20 it's gone down to 149.20. Now, all you need to do is that you just need to understand what is a pip, right? That's all you need to know, and that's the reason why I've just given you examples. Because once you start trading and once you install your application, it could be MetaTrader or any trading application that your broker is going to give you. Once you start looking at these pairs, you will obviously quickly understand what we mean by a pip. But if you're just starting off, this is all that you need to know, that what is really a pip, right? So you can see there are two things. So here you can see in all other pairs, we were looking at the fourth decimal, right? So in all other currency pairs, we're looking at the fourth decimal, right? So the fourth decimal move is a 1 pip. Then you saw other examples as well. In case of yen pairs, we are looking at the second decimal as a pip. Correct? So this is how the market moves, right? So if you look at the dollar yen rate from 120.10, it went up to 120.60. It simply means that dollar yen has moved up by 50 pips. Vice versa, let's say if 120.1, in case of the pound yen, 150.20 was the rate. Let's say you sold this currency pair and then the price went down to 149.20. That basically means that price of currency pair pound yen has dropped by 100 pips, right? So this is all you need to know. It's a very simple beginner's video, so I'm only going to talk about the concepts. I'm not really going to get too deep into it because it's not important, especially if you're just starting to trade, right? So now let's look at lot size. Now when you look at lot size, just simply understand for ease of understanding, obviously you have 8 major currencies, right? So you have 28 currency pairs. 28 currency pairs is what most of the traders are trading on a day-to-day basis, and your lot size is based on your currency pairs can change. But for simple understanding, right, for a very simple understanding, let's put it this way, that whenever you are trading, right, so if you are trading a micro lot, so lots are, we're talking about three different lot sizes. So there's a micro lot, right, which is the smallest lot that you can trade. Now, typically brokers will offer you micro accounts, right? A lot of brokers nowadays allow you micro accounts, and if you're a beginner, I'm sure that you're going to start a small account, maybe with $100, $200, and you will start trading. And obviously, when you start off as a beginner, I highly recommend that you start trading with micro lots, right? Because these are the smallest lots that you can trade in. Now, micro lot simply means that it is 1,000 units, right? So if I'm whenever of the currency pair that you're talking about, so you have a micro lot, right? So if you're trading a micro lot, then the value of every one pip, right, is 10 cents. So if you remember this example, when the price moved up by one pip, so if you, the same example, if you were trading on a micro lot, then we are simply saying that if you're trading a micro lot, which is 1,000 units, then every pip is 10 cents. So if the currency pair that you were trading, it went up by one pip, you simply made 10 cents, right? Second, you have a mini lot. Now, obviously, a lot of brokers, almost every broker and every broking account will have mini lot and standard lot. And if you, most of the brokers offer micro lots as a separate broking account, but you can definitely get in touch with your broker. Most of these lot sizes are nowadays available with any broker of your choice. Everybody offers this, right? So all you need to know that micro lot is 1,000 units. Then you have a mini lot, right, which is 10,000 units. So if you're trading a mini lot, then simply means that the value of every one pip is $1. So in the same previous example, let's say dollar yen went up by one pip, and if you were trading one mini lot, that is 10,000 units, then on every pip move, you would have made $1. In this example for micro lot, you would have made 10 cents. Again, if you're looking at standard lot, so if you're trading a standard lot, then the value of every one pip move would be $10. So let's say if dollar yen moved up by 2 pips, you made $20. Correct? So these are the three lot sizes. So whenever you open an account with any broker, in fact, even if you open a demo account, you have these options, right? So you can simply open an account, a demo account with any broker of your choice. And since it's a demo, it doesn't really matter. You can choose any broker. If you're opening a real account, then obviously you need to do some due diligence on selecting the right broker. I will make a separate video on that about which broker I really trade with, and I prefer them because I've been trading with them. But if you are a beginner and you just want to do some demo trades and you want to understand lot sizes, you can simply open a demo account with any broker just for understanding, and at the same time, you can start trading as well using your demo account. Right? So you have, when you talk about lot sizes, we have micro lot, which is 1,000 units. Mini lot is 10,000 units. You have standard lot, which is 100,000 units. In a micro lot, on every one pip move, you make 10 cents. Or in a mini lot, on every one pip move, you make $1. Similarly, in a standard lot, on every one pip move, you'll make $10. Now, if you can see here, right? So I'm saying that on every one pip move, you make 10 cents. Now I'm telling you this for general understanding. The reason being, every currency pair will have its own value, right? So let's say if you are trading the euro dollar, on every one pip move you made 10 cents. Now, if you are, let's say you're trading Australian dollar against a Canadian dollar, then the pip value. So what you are looking at here, this is called the pip value. How much are you going to make on every pip, right? So this pip value can change depending on which currency pair you are trading. But to get an overall idea and a general understanding of what a lot size is, this example is good enough for you to understand that there are three different lot sizes. There is a micro lot, there's a mini lot, and there's a standard lot, right? And every lot will have its own pip value. Obviously, the micro lot has the lowest pip value, then you have the mini lot, and then you have the standard lot, right? So this was about lot sizes. Moving on, let's have a look. Let's go a little deeper into lot sizes. So let's say if you bought a standard lot of euro dollar at 1.1200. Okay, so I am saying you bought a standard lot, that is 100,000 units, right? And price moves up by 10 pips, right? So if you remember in the previous example, in the previous slide, we discussed pips. So here we are just looking at, like a live example. So let's say you placed a trade of one standard lot of euro dollar, and when you bought it, it was 1.1200. Let's say 10 minutes later, it's gone up by 10 pips, and now the new value, because it's gone up by 10 pips, you can see the fourth decimal and the third decimal, right? It's gone up by 10 pips. So 1.1200 became 1.1210. Now, since you're trading a standard lot, each pip, so the value of each pip is $10. So how much profit did you make? You made 10 pips. Each pip is $10, so you made 10 into 10, which is $100. So you made a $100 profit because you were trading euro dollar and it moved up by 10 pips, and that's the reason why your overall profit was $100. So why? Because your pip value was $10 per pip. Now let's say if price moves down, right, by 10 pips, and it's now at 1.1190, then what happens? Now let's say in this example, like I told you, you bought, right? So you were buying euro dollar. So if price moves against you and it went down by 10 pips, so 1.1190, then what happens? You've lost $100. Why? Because it's moved down by 10 pips. Obviously, you are buying the euro dollar and price goes down by 10 pips. So then obviously you're not going to make $100. Instead, you stand a chance to lose $100. Why? Because obviously there are, whether you're going to have a stop loss, not. So we're not going to discuss all that. We're simply saying that if you're buying it at 1.1200, price moves up by 10 pips, you make $100 profit. If it goes down, then obviously you don't make a profit. You're going to make a loss of $100. Now, similarly for a mini lot, because the pip value is going to be $1 per pip. So if you were trading the same example, right, in this same example, what is going to happen? That if you were trading a mini lot, then your pip value, and it goes up by 10 pips, then what happens? Because your pip value is 1, you make a $10 profit. Same way, if you were trading a micro lot, it goes up by 10 pips, you make a $1 profit. So micro lot would have given you a $1 profit, a mini lot would give you a $10 profit, and a standard lot would give you a $100 profit. Obviously, as and when your lot size grows, your profits will increase or decrease in the same proportion. The reason being, the more risk you take, the more reward, right? So, I mean, that's not something new. So, as and when your lot size increases, your pip value will definitely increase. Now, calculating lot sizes can be done with risk management tools. Now, the reason I don't want, especially if you're just going to start off, I don't really want you to get too much into these calculations on your own. The reason being, internet is just full of these tools which automatically calculate lot sizes. There are so many risk management tools. In fact, if you check my own YouTube channel, I have left the description below. You can check out that video. There's a free risk management tool that we have, which you can download and you can start using it on your MT4 platform, right? So basically, what do these risk management tools do for you? They make your life easy. They simply calculate based on your risk percentage. Depending on how much you want to risk, it will tell you. For example, I have this calculator here. So you can see it's a dollar account. Let's say you have $1,000 account and you want to risk 3%, right? So you're risking 3%. Let's say I want to risk 2% per trade, and you have a stop loss. A stop loss basically means that a point at which you do not want to lose any further, right? We'll discuss this a little later in the video, but just for your understanding, I'm telling you. So you have $1,000 account, you have a 2% risk, and you can see the moment you put your risk percentage and the amount of pips that you're willing to lose. Obviously, stop loss is very important. I'm sure a lot of beginner traders, especially in Forex, most of you must have traded in the stock market. because that's what typically happens, that a lot of people who move into Forex have some experience in the stock market. So it's the same thing. Like in Forex, obviously stop loss is extremely critical. The reason being this market is highly liquid and volatile. So obviously having stop loss on every trade is absolutely critical. So based on your account balance, your risk percentage and the stop loss and the currency pair, here you can see it is suggested you the lots that you should be trading, correct? So it's even telling you that the amount you're risking is $30 and these are the lots. So if you're looking at a micro lot, it is 4.28. If you look at a mini lot, it is 0.42, right? 0.42 mini lots, and this is the standard lot. So for example, if I change it, you can see here, let me give you another example, because here I'll have to add the price. Let's say if I change it to pound dollar. So here you can see $1,000 account balance, 2% risk, stop loss of 50, and it's telling you that your position units, right? This is how much you are ideally supposed to be trading, right? Based on your account balance and the amount you wish to risk, this is what you should be trading. So what is the position size? 4,000 units. What does this basically mean? 4 micro lots, right? This simply tells you 4 micro lots. So that's what I told you, that there are a lot of uh, calculators online, so you don't really have to really do all this on your own. What is more important is that you understand the logic behind it. That's all you need to know. You just need to know there is a micro, mini, and a standard, and obviously each of them have a value attached to it based on the pip move or the profit or the number of pips that it moves. Your pip value and your profit is directly dependent on that, right? So you can obviously look at the link in the description for the free risk management tool that we have, and you can use that as well, right? So like I told you, simple risk management to tell you is, if you are starting off in Forex, for that matter, you must have seen, if you know any traders, they all will tell you the same thing, that there is a certain amount that you need to decide. So if you have, let's say, $1,000 account balance or a $10,000 account balance, it doesn't really matter. The thumb rule is that you need to have a risk percentage fixed, right? That on every trade there is a certain amount of your total capital is what you're willing to risk. So like you saw in this example here, that you have $1,000 account balance and you want to trade the pound dollar. So what is it saying? That you have $1,000 account balance and you have a currency pair which is pound dollar, and you are going to risk. So here, if you can see, if I increase the risk to 3, it's asking me to trade 6,000 units, or simply means that I can go up to 6 micro lots. So if I increase this risk percentage to, let's say, 12, so which means I'm saying that on every trade I'm going to risk 12%. So you can see suddenly this is the amount. You can see suddenly the number of lots have increased. What does this simply mean? Obviously more risk, more reward, but does that really mean that you're going to risk 10, 15, 20% per trade? Obviously not. So as a general rule of thumb, what traders follow is that you risk anywhere from 1 to 3% per trade, and based on that, your risk percentage, and obviously depending on your stop loss, you will decide how much lot you should be trading. And this is very critical because obviously if you're a beginner, you will understand the importance of this as and when you progress, because you can ask a lot of forex traders who've been trading for a very long time, or even if I have to tell you as per my experience when I started off. So like many other forex traders, even I have blown some accounts, and that used to happen. The reason being, I would never really follow risk management. So I didn't have a set rule that, for every trade, I need to have a fixed percentage of risk. I would just take random trades. Sometimes and I would never even calculate risk percentage, to be honest. I would just pick randomly one standard lot or 5 mini lots. And even I didn't know what I was doing, but it's just that over a period of time, I understood the importance of a risk management tool, because you may be having the best of strategy, but all it takes is one or two bad trades to really blow up your account, right? That's how powerful Forex is, that it has the power to really make massive profits, and it has the power to really make sure that you lose all the money. So that's the reason why having a risk percentage fixed is very important, and I think this is the most important takeaway in this video, at least, because I can't tell you how important it is as a beginner trader for you to not lose focus and make sure that you have your risk percentage fixed. It is absolutely important. And the reason why it's so important is because it will allow you to stay in the game. Now, what I mean is, let's say you have $1,000 account, but if you just randomly keep picking lots and you got one or two bad trades, that's it, your account is blown and then you're out of the game, right? But when you have a fixed rule that, I'm going to be trading 2% or 3% or 1% per trade, then what's happening is that you may have a few bad trades, but you are still in the game because you still have money to place your next trade, right? So this is what is the power of risk management, and it is very important. So um, the reason I don't want to make it too complicated is because there are so many tools available online which make your life easy. So it doesn't really make sense for you to get into the maths and understand why it really works. And even I never bothered, because when you have tools which can do that for you, then why do you really want to get into it? For you, what is most important is to follow discipline, because in spite of uh, you know knowing everything, you may just have a very bad risk management and you will just end up losing money anyway. So it doesn't really matter. All you need to know is that you need to be disciplined about your risk percentage. If you have decided 3%, then you simply go as per 3% per trade. So here you can see your most important takeaway again. So there are a couple of slides which is the most important. So this would be the most important thing that I would personally want to tell you is risk management. Your lot size clearly depends on your stop loss, right? Now, the smaller the stop loss, higher the lot size. The wider the stop loss, the lower the lot size, right? So it's very important. Now here again, if I go back to the same example, you can see if I increase the stop loss, it is going to reduce my lots. If I reduce my stop loss, so your stop loss and your risk percentage, right? These two things are interdependent, right? That's the reason why if you take any risk management calculator, they will always have these two criteria: stop loss and risk percentage. How much is it that you're willing to risk? So, and what is the number, the pip stop loss that you're willing to risk? Based on that is what your lot size is decided. So if I keep reducing my stop loss, my lots will increase. If I increase my stop loss, my lots will decrease. Right now, this is the power of risk management, and I can't stress how important it is that you follow this right from the first trade. And uh, this is it. I mean, this is what you need to remember. So there is a risk management tool which the link which I have given in the description. You can use it as a free tool. The best part is that it makes your life simple. It's just some drag and drop lines. You simply drag and drop some lines, and it will automatically tell you what lots to pick, and it makes your life very easy. I use it, so I've shared it with you. It's a free download. You can go and download it for yourself. Right. So now coming to the second most important point, which is leverage. Right now, this again is a concept which was not made clear to me when I started off trading. So that's the reason. The whole reason of me making this video is to explain two concepts. One was risk management, and I want to keep it simple. That's the reason why I kept risk management as a very simple rule of take any thumb rule of 1 to 3% and fix that risk, and then continue trading, right? Irrespective whether you have a win or a lot, doesn't matter. Follow risk management, right? Second, the most important thing is leverage. Like I told you, nobody really told me about this. That's the reason why I am trying to tell you this. It is very important. Now, you may, if you have started off forex trading, you may have gone to a lot of website, lot of broking websites, and all brokers offer nowadays. You have a lot of brokers who say that we can offer you leverage of 1:1000, 1:500, 1:100. So what is leverage, right? It's a very important concept, and I'm just going to try to make it as simple as I can, so that you can understand it easily. I've attempted to explain it in a very simple manner, because there are a lot of videos on leverage online. Some can get very complicated, but honestly, it's a very simple concept. So let's see if I can do the job and try to make it a very simple concept to understand. So since a lot of you, or at least a lot of traders who come into Forex, they have some background of trading in the stock market. So I'm going to use a stock market example instead of Forex, because it becomes easy to relate. Because even myself, I was trading in stocks. I don't trade in stocks. I invest in the stock market. So I'm not like a day trader in stocks. I'm more of a position trader, or I simply buy some good stocks and I just don't look at them. So it's very easy for me to relate to the stock market, and it'll be easy for you as well, right? So let's say you have a trading account and with 10,000, right? It doesn't matter whether it is US dollar, pound, euro. You just have a trading account with your trading account is 10,000, right? And it could be any market. Now, let's say in this trading account, you bought shares. So in this case, I've taken an example of ABC Corporation, which is some company, and you bought shares, 100 shares of ABC Corporation, which is 100 rupees per share, right? 100 shares, each share is priced at 100. You can call it rupees, dollar, euro, doesn't matter, right? 100 shares worth 100, right? And let's say price went up by 30 points or dollars, or in this case, let's say it's gone up by $30. So you made a profit, right, of $30 per share, right? So you bought 100 shares of ABC Corporation, and which is $100 per share. Price went up by 30, so you made a profit of 30, correct? Now, what is happening here is that your total profit is 100 into 30, so per share. So what is it in dollars? So 100 shares into $30, so you made a profit of $3,000, right? So very simple example of a stock market. So you bought this 100 shares, you made a profit of $30, and your $30 profit per share gave you a total profit of $3,000. Now, let's say that your broker is willing to give you credit, right? I'm going to use the term credit, 10 times more than your original capital, which means that now 10 times 10,000, right? Now your capital has become 100,000. So if you remember here, 10,000, correct? And with this, you were able to buy 100 shares of ABC Corporation, which was 100 rupees, $100 per share. Price went up by $30. You made a profit of $30 per share. So your overall profit was 3,000, correct? Now, same example, let's say your broker is willing to give you credit 10 times more than your original capital. So your new capital now is 100,000. So in this example, let's say we go back to the same ABC Corporation share and we use the same example that it went up by $30, and but this time you bought 10 times more. Why? Because you had even though you only have $10,000, but your broker has given you credit, so you bought 1,000 shares instead of 100 shares, right? So now your profit is 1,000 into 30, which is $30,000. Now, can you imagine your investment was 10,000, right? The broker gave you some additional amount of money as credit, right? And you made a $30,000 profit. Wow, right? I mean, you had a $10,000 account, you made $3,000. Broker gave you credit. Suddenly, now you are sitting on a $30,000 profit. Your amount of money that you had put on the line is still the same, correct? That is a $30,000 profit. Now, right until here, everything looks very good. Now think if you had a loss of $30, which means a straight loss of 30,000. In this case, you would end up blowing your account. Why? Because you had $10,000, price has gone down by $30, so obviously you've made a loss, right? So as long as this credit, the so-called credit broker is willing to give you, and you've taken the right call, then you'll end up making good profit. But if your call goes against you, then you'll end up losing practically everything, right? So because this is what a lot of beginner traders do, and the reason I'm saying is because even I did this. That's why I'm telling you I have done this, and that's why I'm telling you that if you're just starting off, then don't make this mistake, right? So in this case, if you lost money, then you've lost everything in this example. Now, before we even proceed, this is the most important thing that you need to remember, that the broker never loses, right? So please remember, broker is not going to lose any money, right? Broker is going to make money. The only person who's going to lose money is you and retail traders like you and me, right? So obviously, brokers are not going to lose any amount of money. Why? Because firstly, why do you think the broker should even give you credit or leverage? See, any broker, his business is brokerage, right? So he is in the business because he wants to make his brokerage. He is not really bothered whether you win or lose, right? He just wants to make sure that he encourages you to trade more, and if you trade more, he makes more brokerage, right? And like I told you, he doesn't really care if you make money or not. Now, this is what you must be thinking, and this is what even I used to think, that uh, this is back then many years ago, that don't you think that even the brokers are going to lose money? Now, brokers are not risking anything, right? Because um, he's not really done anything for you, correct? You are thinking that even, in this previous example, there's a $30,000 loss. So you please don't be under the impression that you lost your 10,000 and the balance 10,000, the balance 20,000, the broker lost. No, broker never loses anything, right? So what typically happens is that you deposited $10,000. Right now, this is your money, right? And let's say when the broker is giving you any kind of credit or leverage, it's the same thing, right? When he's giving you some money, and what has happened is that this $10,000, which was your money, right? This is kept with the broker as a margin, correct? So typically, what happens is that your broker would obviously keep your position open to a max loss of the amount that you have given to him. He is not going to take any loss, right? So that's what you call a margin call. So in this example here, just to make it a little more easy to understand, that he's allowed you to trade more, correct? He's allowed you to trade more, and obviously you made profit. But remember that when you're losing, right, there's a cutoff. The cutoff is 10,000, right? In this case, there was 10,000 that you had. That is the cutoff. He's not going to take any loss. So like I mentioned here, brokers have a margin call which is typically 90-95% of the original. So let's say when your loss is close to 9,000, or let's say negative $9,000, you will see a margin call. So basically what's going to happen is that your positions will just be closed out automatically, because he's not going to let that loss go into him. He's not going to take that loss. The amount that you give to the broker, right, that is your money, and you stand to lose only your money. So this is the most important thing that you need to understand, that don't get carried away by leverage. Don't get carried away by bonuses that brokers give. You will see, you know, they say, you have these ads going on where they say you do a deposit of an X amount and you get 100% bonus, 200% bonus. logically think about it. Why would anybody give you free money? I mean, why would any broker do that? Secondly, why do you think the broker will lose because you took a bad decision or you took a bad trade, right? If you're taking a good trade, you are making money, good. But if you're making a bad trade, only you stand to lose. Broker is not going to lose because he's not in the business of losing. He's in the business of brokerage. His job is to make brokerage, right? So remember, uh, leverage is nothing but borrowed money just to increase profit potential. Now, the same example, if you look at Forex, you will have, let's say, a $1,000 account. So if you're using no leverage, right? You are using no leverage at all, then simply this $1,000 is going to allow you to trade one micro lot. Simply put it as 1,000 units, right? For simple understanding, right? So if you have $1,000 account and you are at no leverage at all, then you simply are trading 1,000 units. Now let's say you bought, we'll take the same example of dollar yen at 120 and price moves up to 130, right? So which means you made a 100 pip profit. And in this case, because it's a micro lot, you made a profit of $10. Now let's say you're at a leverage of 1 is to 10, right? 1 is to 10, which means now you can buy $1,000, which is your money, multiply that by 10, that's 10,000. Now dollar, so now the dollar yen trade will make you a profit of $100 as you can now buy a mini lot. So what has happened is that the broker is simply allowing you a platform. He's giving you a platform where you can trade more, right? You can trade more. Now there are brokers who are going to take this leverage to from 10 to 1,000. There are brokers who offer 1 is to 1,000 leverage, 1 is to 500. I have seen brokers who are giving 1 is to 2,000 leverage. But those are just tricks to entice. I mean, if you are trading on 1,000 or a 2,000 leverage, you won't even last in the market. If you take one bad trade, you won't even last for minutes. I mean, honestly speaking, with a small account like a micro account, and you go at 1,000 leverage, you will just end up losing in minutes. One bad trade, and you are out of the game within a span of 2 or 3 minutes, right? Similarly, we go to another example. If you're trading in a leverage of 1 is to 100, which means your $1,000 is now multiplied by 100, so you got more buying power, and it is now $100,000. So with the same dollar yen trade, now because you have a potential of 100,000, you can make a profit of 1,000. But in all these examples, remember that only your money is on the line. The broker will not lose. He is only going to take your money. The idea here is that brokers are offering higher leverage, right? But then again, if you think about it logically, for if you are a smart trader and you trade a very good strategy and you are very strict with risk management, where you're saying I don't risk more than 2%, and you're using leverage as well. So it's not all bad, right? But it's just that if you just over leverage yourself without knowing what you're doing, then it's just a recipe for disaster, because you will just end up blowing accounts one after the other. And don't do that mistake. And these are things that I'm telling you with my experience, because I have done this mistake. Because the leverage that is offered in Forex is huge. I mean, I don't think there is any other market that really allows you. There's no market, even stock markets don't. Nobody really gives you so much leverage to trade. So it all depends on you how you use it, and especially if you have a very strict risk management and you use a decent leverage with a good strategy, then that is enough for you to stay in the game for a very long time to come. And like I told you, the most important takeaway in this is definitely risk management. Right from day one, understand that risk management is the key to stay in forex trading in this game. If you are starting an account with $1,000, follow a risk management of, let's say, 2% per trade, and uh, start with maybe a leverage of 50, and you will stay in the game with a decent strategy, right? Now, you obviously can't say that you have a bad strategy and you should end up winning. What is going to happen is that you will have a bad strategy, but you will still remain in the game. The reason being, you have a risk management rule. Your stop loss, you have a stop loss in place. You have a risk management in place. Because of that, you will end up staying in the game for a longer period of time. That gives you chance to recover and come back, right? So this is the most important thing that you need to remember: risk management. Now, like I told you just before, remember the idea is to last longer in the game. The higher the leverage, the higher the chances of you getting margin calls and accounts getting blown, right? Leverage is single-handedly responsible for blowing accounts. Now, it all depends on how you handle it, and this is why risk management is the most important factor for winning in Forex, right? Now, like I told you, you can trade with a risk percent of 1 to 3, leverage of 50, and with a decent trading strategy, you will stay consistent. And I'm sorry about this, and you will not blow up accounts. So you can obviously use the free risk management tool, right, which will automatically calculate it. Like I told you, there are many tools available online as well. So this is one on baby pips. But if you want something which is directly on your screen and you don't want to, on your metadata application, then you can download the free one, which is available in the link given in the description, right? So the three key takeaways, if you would ask me, if you're starting off to trade, then the most important thing I would ask you to remember is this. If you can predict rising currency against a falling one, then you can make money. So if you're a beginner trader, this is rule number one. You may be trading any strategy. It could be, I'm just randomly putting it out. It could be MACD, it could be RSI divergence, it could be support resistance, whatever you're trading, any strategy that you pick. And because you were just starting off and you were a beginner, remember that what does Forex mean? Forex means an exchange, right? Forex is an exchange. You are exchanging one currency for another. So the most important thing in your strategy is that you should be able to identify the rising currency against the falling one. If you are correctly predicting rising and falling currency and then you club it with your existing strategy, with a good risk management, of course, of 1 to 3% and a decent leverage, that is all you need to stay consistent in Forex, right? And that is literally all that you need. One is that you need to follow strength and weakness, which means you are in a position to predict a currency that is rising against a currency that is falling, right? This is the most important thing that you remember. And if you go to my channel, there are a lot of videos that I've made on currency strength and weakness. I highly recommend, if this is the first video that you're watching, I would highly recommend that you go and watch that video. I will leave a link in the description. Watch that video as to why currency strength and weakness is so important. Once you are clear with currency strength and weakness, then obviously the most important thing, like I told you, is risk management. So you need to know, you need to follow risk management. You need to have a fixed risk in place, right? And once you have identified, once you follow currency strength and weakness, you follow good risk management, and obviously you don't over leverage yourself, you are good to go, right? So I really hope that you like this video, right? Here are some points that I have mentioned on the screen. We've already discussed it throughout the video. And if you like this video, please like it, share it, subscribe to the channel. I intend to make more videos soon. You can join our free Telegram channel. The link is in the description and also on your screen. And I look forward to seeing you in our next video. Thank you. Bye bye. Have a nice day.